Welcome everyone to the Kendall Report. Sorry I'm a little late tonight. Been a crazy afternoon to say the least. What a day, huh? You don't want to get in the way when a market breaks out. And I think it's sort of funny. I saw somebody saying that the shorts got crushed right after the open. They did. And it was steady up all day right into that. There was a RXT sell signal on the hourly chart 3 hours before the close, so we kind of drifted sideways and in, and we're still seeing a little bit of downward pressure. And I think somebody mentioned, hey, we're probably ready to go into fall back into the moving averages, and we are getting a little frothy up here. It's hard to believe. We go with the contract rollover, and we'll be talking with the September contract tonight. I've stuck with the June kind of back and forth all week, just trying to make this transition a little bit here. But we printed up to 4470 plus, and those are really, really big numbers, and they seemed ridiculous. And in fact, some of you told me it was ridiculous on the comments on the channel that we were not going to see 4400. So there's not, let's say this, there's not as many people that are bearish as there were. But there's still plenty of them out there. And I think that it's hard. I would say it's difficult. I went on a pretty good rant last night. So if you didn't see last night's video, go back and watch just the opening comments last night. But we're really just seeing, this market just taking off here. And we're seeing a little bit of a rotation. We haven't seen the small caps come in, and there's a lot of issues with the small caps. There's a lot of bank stocks, and KRE did fairly well today. The community banks did not. So there's just a lot of crazy rotation. I don't think I was a bond trader throughout the 80s, and primarily with institutional bond trader. I have never, even back when rates were really crazy, maybe in the beginning days when Volcker came in, we saw this volatility like we're seeing right now. But we're seeing some pretty substantial volatility back and forth day to day. I'll cover that in a few minutes. And we're just, it's a crazy scene out there. So I broke down a lot of things last night, and I'll just try to recap just a little bit to bring in some context here. After the Fed meeting, the Fed told us, like I said last night, they're going to do what they said. I believe them. I'm one of the few that have believed them. They're going to raise rates 2 more times. Markets, you would argue, don't really care. I don't think that's what's going on in the markets. And I'm going to stick with this scenario that I've been talking about for a while with you folks, is that the Fed is normalizing rates. Rates are normalizing. I was watching on Bloomberg today, one of the CEOs of a major home builder, I think it was Leonard, came up, and they said, he was like, hey, we're selling houses like crazy. And their stocks all-time new high. All these things are going crazy, and they're 7% interest rates. And people are finally starting to step into this market. And one of the things with the housing market, just a quick comment, is it's not even a fair scenario, because what's really going on is we've been underbuilding in the United States for decade plus, actually going all the way back maybe 15 years to GFC. There's not enough housing out there, so there's been a lot of multifamily built. There's a lot of folks haven't wanted to or haven't been able to buy. But now what we're seeing is millennials are starting to get a little further down the trail in their careers and money, and they want to step into the ownership. And I've just a little segue for a minute into demographics. My group, the boomers, we're the biggest group out there. Now it's millennials by a big gap. And then they're followed by the Zoomers, which are the smallest group ever. So what you're seeing, I've talked about this, you're seeing a peak in population across the planet. You're seeing it in Japan last year lost 680,000. China will lose something like 400 million in population, I think, in the next 50 years or so, something like that. I may be wrong in that number, but they're going to be losing. And the only place that's growing on the planet right now is India from a population viewpoint. So it's kind of interesting. But the reason why I bring that up is the millennials are now coming in to the housing market, and that's where the bid's coming from. And 7% seems like a lot of money, but maybe when you've been financing everything on credit cards at 18 and 20 plus, maybe it doesn't seem that much to this group of folks that are coming into the markets. And the millennials are going to drive the markets forward in a big way, just because of the pure demographics, the numbers, all of those things. As they become, they're in their 30s, and I remember when I was in my 30s, I told you before, I bought a house in California and paid, I think, 13.25% interest rate. But guess what? I was like 37, 38 years old when I did. I didn't think anything about it, man. I'm alive. I'm working. I'm making money. Let's go get a new house and build, expand the family, do all those kind of things. That's what you think when you're 38 years old, and you should be thinking that. So there's a sweet spot coming in to that demographic. Okay, I'm done with that. But the point of that is there's going to be a lot of economic activity that's going to be driven in the years going forward. So I think folks are making a really, really big mistake. This is an opinion in trying to talk about this recession and all the things that, I'm doing air quotes here, that we're going this coming recession, the expected recession, you can call it. Now it's soft landing. Maybe it's not going to happen. I've been telling you for a while it's not going to happen. But there's, with the, let's just say, generative AI coming out with all the things that are going. I spent probably 2.5 hours in ChatGPT today. And what was I doing? I'm programming a script, and it's been amazing. This is for the new release, and it's making me crazy. I got a couple little errors I almost got worked out. I got one of them done. I got one more to go, and I'm super excited because one of the things that I want to do is to be able to take some of the concepts and get them into so you can have them. So you folks, and we haven't figured out how to distribute this. I'm probably just going to give this away, but it's I've talked to you folks about the 3-day trade, and so I am developing the final logic. So the 3-day trade just pops up on any chart. It could be a 5-minute, a daily chart, whatever you want, but it's going to set up the rules, and I'm just going to make that public domain. We'll figure out how to distribute that, but I want that out there. And there's a lot of concepts that I want to do. Some of them will be completely public domain. Some will be the invite-onlys and the protected class of ideas that I have. But a lot of things I talk about, I'm really excited about being able to do this. And as I told you before, I've been telling programmers and coders for the last 30 plus years how to get my ideas out there. Now I have someone I can just keep asking questions and telling them what to do and work through a lot of these issues. So it's been pretty interesting experience for me. Anyway, so I digress back into the markets, but this is the point, as a lot of us are getting skills right now through the use of whether it's the GI, the generative AI, or whatever it is that's going, but this is going to increase productivity. You've got one of the largest groups of population ever to come into the sweet spot. I tell everybody in the 30s is a crazy, mid-30s on. You get into 40s, that's where it cranks. I started my VPN partners and all that when I was 45 years old. And so lots of things happen. I know probably some of you, 45 sounds like it's old. It's not old, okay? So this is my point, is that a lot of things that people are trying to tell you what's going to go on going forward is not what's happening. Excuse me. A lot of folks are talking about the hype over AI. I'm not sure you could hype it enough. With my experience and experience internally, just here with Kendall Report and people around me, we've had crazy experiences with ChatGPT, and we've been on chat since last December, I think it was. We were very early adopters, so I'm becoming a pro here at this point. So my whole point of talking about this is simply because this is going to drive a lot of things that folks aren't looking at. So the economy is going to start to do better, and you can call it hype on AI, but any of us that have ventured into that world know that it's not like the .com, boom that was going on. This is very, very real, very impactful on the economy, and most importantly on GDP from the standpoint of productivity. And productivity is the single most powerful multiplier in an economy. So if you can get more productivity out of individuals, I won't go through the whole scenario tonight, but this is what's going on. And I think you're seeing the markets wake up to that. So people are talking, I saw somebody on CNBC make a comment like, well, is this rally just going to quit and we'll go back into our bear market? There's no bear market, okay? That was last year, okay? We are not in a bear market. And we have been, and I've been, you folks know this from watching the channel, going all the way back to October, fourth quarter of last year. Everything was starting to turn around as we came into January, February. Our database got a lot of traction, which has pushed this market way forward. And I told you that, we had 50, 60% of our database in trend mode with expectations of approximately 200 days of holding and a 30% gain in those stocks. That's on average. That's the mean returns on 10,000 stocks that we're looking at. So these are very, very big numbers, because obviously some are going to do a lot better. I think we own NVIDIA from 199 is when we bought NVIDIA. So those of you who have WaveTech, you already know this stuff. And so this is what's going on. And how far does this go? I don't know. It's not going to end right now, I will tell you that. And whether we get a little pullback or nothing's a straight line, I'm not saying just up, and away. But we are way, way closer right now to an ATH than we are if you go back to October of last year. 35, I believe 3502, if my memory is good, was the low. We're printing 44, almost 45. That's 1,000 points. The old highs are the 48 handle. So we're a lot closer to all-time new high than we are a low. So don't be talking yourself into a bear market and all of those things. I feel sorry for a couple buddies of mine, some very well-known, that are continuing to put some kind of macro view, and all this stuff is the opposite story, I'm telling you, that somehow all of this stuff is going to implode. And it is not, I'm telling you. And I've been telling you, this is not a new story for me. So let's just take a little bit look back on yesterday from the standpoint of what's going on. We had claims come in basically unchanged, 262,000. Continuing claims was up 20,000, up to 1.775. So employment just stays steady on a week-to-week level. Empire State report was up 6.6%. I think it was expected to be negative. So that was a big surprise. But most of the other data, I won't go through data point by data point, but most of it was mixed, some a little better, some worse, but nothing. There's no catastrophic numbers out there. And this is what the Fed's seeing, and this is what I've been telling you. I know Powell seems to act like he doesn't know what's going on and hasn't seen some of the reports. I'm telling you, they have ongoing reports. They know what's going to happen long before it happens, and they know all these reports ahead of time. It's not a surprise when they're in an FOMC meeting. They're not blinded. They're not guessing. They're not throwing darts in there. And I told you, I'm giving Powell and Company A+ on what they've done. And I was, if you go back a year ago, I was in the camp that they were too late, and maybe they were going to break something, and it, for whatever reason, the markets and the economy doesn't seem to be breakable at the level that we thought it was. But I think it has to do with my little dialogue that I just talked to you about, is that a lot of things have materially changed all of a sudden. And even Paul mentioned something, he did make a side comment about the banks, and I've heard that there's 30, 40 banks that they're watching. There's always 30, 40 banks that they're watching, folks. If you think you have 4,000 banks plus in the country and there's not 30 banks with issues, then you haven't ever looked at the banking system. There is, I've told you before, the banks, that's a tough business to be in. There's a lot of things that can go wrong in there. So anyway, I've been kind of on a rant for most of this stuff. Tomorrow, only thing coming out, we got U of M, University of Michigan sentiment numbers coming out. They're at 60.2. That's the expectation, the best I can tell. So we have, looking at that stuff, that's not going to tell you a lot other than things are a lot better than folks were telling you they were going to be. And now they're trying to build the next scenario up, right? So the next phase will be coming into the next earnings season. And I will just tell you right now, in an environment like we're in right now, the probabilities of earnings being really, really good or beating what the expectations are probably 60, 70% of everything that you're going to see when we do come into earnings is going to come out better. And I've talked to you before whether that's a conspiracy, meaning that they underestimate so they win, or whether the companies and all of the forward-looking ideas, they're under betting. It's you always want to outperform whatever the expectations are, right? So you underpromise and outperform, and that's what's going on. The only other scenario that they got out there left, and it's getting a little lean, is commercial real estate. So CRE is the next catastrophe that everybody's talking about. And I'm telling you, that's not a catastrophe. If you look at who owns most of it, it's going to be an extend and pretend, meaning that they'll just go, hey, listen, you've got a loan coming due. Can you pay anything on it? No, you're a little tight. Let's just extend it. Can you make at least one payment here and there? And they'll just extend it, and they'll figure out how to get through it. And I think ultimately, I know a lot of you and a lot of folks think that employment scene has changed forever. Those buildings will have activity in it and they're not going to convert commercial buildings into apartment buildings. They don't convert. There's not the infrastructure inside those buildings to do that. People will be sitting in cubicles and working in buildings again. I think there's just something to be said about interaction with people face to face. So that's why I think Elon and a lot of other folks have pushed that. Okay, I'm done with all that. Let's get into the technicals. I'll set up the end of the week. I said I'll probably continue to do a Sunday afternoon, try to do it fairly early so I can keep things rolling. I do have potential couple hiccups that could happen next week with the scheduling. I'll just let you know as we go. So let's get into the technicals and take a look at what's going on with the S&P. All right, so we'll start with the hourly. Hourly's chart is starting to fade toward the 10-period moving average right here at, this would be 2 o'clock New York time, is where we get the RTX sell signal. And then you see we've drifted almost 3 hours now sideways. We're running into this 10 SMA here, but you'll see that the in the next couple hours, we're going to start to see the ppm1 start to penetrate through the first derivative. So the key support, there's a pivot number, there's a couple dots here. Let me blow this up so you can see it. See the green dots here? That pivot's 44.36. It comes right in where the 21 period moving average, this hourly chart. So all of this looks like you can see the hourly algos are suggesting we're going to stay above the first derivative. So this angle is going to be the key. And I would be surprised with the current values. If you look at ppm1, it's 1.41. So a 0.25 or greater is a trend. So it's going to be very difficult in the next couple hours to break through that value. Right now it's 44.53, and it's going about $5 per hour. So you're going to be $10-15 higher in the next three hours. So you're going to have some support. So this little RTX sell on the on the hourly is already pretty much played out and should be in the next hour or so. Okay, so that's kind of where we are. Let's go and take a look. I've been showing you this chart here all week, this crazy angle of attack. ppm1 is now on a daily at 40.89. This is the nearest futures contract. We're looking at right now the last trade at 44.65. We went out at 41.71. We printed a 44.85. So that was above the STX. STX was, let me give you a number, 44.65. So we printed right through that, still closed above it at 71. So we should get 1 to 2 days sideways. So Friday, maybe Monday, we'll see sideways. But this angle is going to drive this thing further, especially, like I said, we're 0.40 on ppm1, ppm2, 0.32, ppm3, 0.12. So it's starting to move up. If you recall, going back about 8-10 days ago, I told you when the ppm3 was trying to turn up that was going to be the next phase. We should see an increase there. I'm going to bring up TradeStation just for a minute, because this right here, there was a buy at 42.83 on 5:30, and from the modeling standpoint, and so we're still long that trade there. And we had been long going back over here on 327 at 40.52. It exited over here at 41.54, got back in. Now it's riding this wave, and like I said, the algos are still suggesting we're going to have a very strong numbers as we go forward. So what I would look for today, let's go to let me bring the market grid from TradeStation here on the screen. Market grid for tomorrow, R182, that puts us up at a retest for the range that we went yesterday, 84 high. S1 44.52, so we haven't quite made it to S1. Typically in a RTX sell signal, you'll go S1, S2 on the day after the sell. And we have seen a number of times where if we go back over here, back to 6.2 on June 2nd, we got RTX sell, we got 3 days, almost 4 days in a sideways pattern, then we moved up. So we should probably see a hesitation here, and the support levels are going to be pretty obvious, I think, as we go forward there. All right, so take a look at the NASDAQ. continues to just climb this crazy situation where we have Microsoft all-time new high, all these big tech stocks are still running things, and yes, they are pushing things up, but I argue that there's a lot of other stocks that are trading right along with them, and it's not just all those stocks. You can't just they can drive it, but that's not the rally we're in this time. And we haven't got, as I mentioned, we'll cover it here in a minute, we haven't gotten the Russell to kick in at the level, probably because there's just a lot of companies in the Russell, not just the banks, that are really underperforming. So it's got an issue from that standpoint, and maybe the economics are, if there is slowing or issues in the economy, they're still playing out there in that small cap arena. But if that starts to get a little better traction, what we've seen, that will be a very good sign for going forward. At the moment, it's moving forward, just not at the same level. It's not outperforming. It's not leading. It's not doing any of those things. And in the past years, I think I showed you before, I won't do it tonight, but I did show you in the past where we're talking about maybe 5 or 6 years of underperformance on this thing. It's on the Russell versus NASDAQ. It's pretty ugly when you look at what's going on. So all the money has been definitely flowing into NASDAQ and not these smaller cap stocks for sure. There have been some great opportunities there, but on a general, from an index standpoint, not so much, especially after the banking issues that we had that really hammered it and flattened it out as well from that standpoint. But the NASDAQ, we're looking at, we did not get an RTXL there. We're just climbing this angle here. PPM1 is a plus 0.53, PPM2 0.56, and 3.41. So we are trend mode across the way. Even though the algos are suggesting we're going to flatten out a little bit, there might be a move back towards the 10. So we've had, this is one of the things, let me just count real quick. So 7. So we're probably, typically in a run like this, we'll get as many as 8 bars, maybe 9 in this upward surge. So there's potentially 2 more days that we're going to close stronger on the NASDAQ. So it continues to be the leader. There's no doubt about that. So you have to recognize what it is. So if you got like the TQs, you got triple Q with the leverage, you're making some bank for sure here. So the bottom line, though, is that even going in, looking out several days into next week, we're going to see stable momentum with the potential of it increasing as we go forward. All right, taking a look at the Russell. It's got a nice, this is daily. It's got a nice angle here that it's running along. So decent, even though it's backing off, we got 0.37 PPM1. So 0.25 or greater is a trend. So we've got a pretty robust trend when you get in there. PPM2 is a 0.32. PPM3 is a little lower. It's playing catch up. But if you start to look at what's happening, is all 3 of these moving averages, the 10, the 21, and the 40, are all in trend mode, and that isn't likely to change anytime soon. Now, we did not get, the only place we got an RTXL signal was on the S&P, and maybe the S&P underperforms a little bit, but everything else is still kind of open to continue the patterns that we've been in. So if you look at, for instance, yesterday, the low of the Russell was 1876. The 10-period moving average was 1872. And yesterday, if you look at where the PPMs were, you're looking at PPM values well up around 0.77 yesterday. So that was the trade. Whenever you are looking at these indicators and you see like a really high number, 0.5 plus, I showed you folks last night, the probability map. But when you see that, when you print that 10-period moving average, you got to be a buyer there if you're a trader, especially intraday. You're going to get a decent bounce off of that. And that's exactly why I point this out and why I put the indicators out there. And those are the points. The matrix, whether it's the market grid, you should also have the 10-period moving average on a daily. Just a simple 10, not an EMA, just simple 10, fine. You don't have to get fancy. Simple math works. And that was a perfect bounce off of that level. And maybe somebody will tell me, well, EMA was exactly the low. It could be. But I'm just telling you that these are good, solid numbers to play off of when you know the probabilities are stacked in your favor that the market's going to hold there. When you have a point like this one is here, up at 0.77, the probabilities of trading and closing below the 10-period moving average are only 10%. I mean, if I told you 9 times out of 10, it's going to bounce here, what do? You folks figure it out. You're pretty smart people, so you'll figure that out. But that's what the power of understanding when a moving average is going to be a valid trend line or valid support line and when it's not. So if that number was only minus point, or it was negative, that moving average would have been penetrated and went through it. You would not make that same trade. But at a 0.5 plus that's an automatic trade off of those numbers. So we go to the 10-year, and this is what I was talking about. If you look at, let's just go to the last 3 sessions, right? On the 13th, we printed, let me get the ranges here, we printed 368 to 384, traded all the way up to R3 almost printed, yeah, actually 384 was RTX that day. Day before yesterday, not today, but yesterday we had 385, 377, and now today we just blow through the moving averages and we go all the way down to 370. The number I've been telling you, that's the number to watch, is 365, 360 on the 10-year. We should come into these moving averages. You've got the 200 period moving average coming in there, 366. The 40 is at 360 even, and we traded right on the 21 at 371. So look for more downward pressure here on the rates. And you're going to ask me, well, wait a minute, Bob, didn't the Fed just say they're going to raise rates 2 times? Yes, they did. But for whatever reason, there's good demand on these bonds, and they're buying them. And so looks like we're just going to stabilize here. So I don't see any big turnaround bull market in bonds and rates going down in any big way. We're really locked in basically into a trading range that we're going to continue for some period of time. This is daily. I'm just going to put the weekly up here, and because I've been talking about this as well. The PPM1 plus 1.2, so that value right now is 361. So I don't see us getting through 360, and that's why I'm putting this number out there. Let's do a quick look at the 2-year. 2-year, this is weekly, still got a nice upward slope. I've been talking to you about these fib targets on the upside, still got targets here we've already hit the 460 target, but 5%, 5.25 on the 2-year. So there's still upside on the 2-year and in the front end of the curve. And that's what the Fed's telling you. They're going to keep the pressure on there. They're going to keep the QT going. So that's happening. And then they're likely to see rates at least another 25 to 50 basis points higher is what they're saying. So yeah, so basically, I think I hate trying to figure out what other people are doing to trade. I'm just looking at what the prices are doing, and the prices are being projected to stay above this 360. And the fact that this is the point. I'll make this point. Is they said they're going to raise them, but they didn't raise them. Okay, so what's going to happen is, as we get into the July meeting and beyond, that's when you'll see the increases, and that's when expectations will be built in these markets. But you can see that on the 2-year, we've got a pretty nice angle of attack. Like I said, where PPM1 is 1.55, and that key value there on that level right now is 430. So it's way below where we're trading right now. We're 465. It looks like we could see a 5 print, maybe even 5 1/4 in here, and this upward slope. This is a weekly chart, so this is multiple weeks. We're looking in anticipation in the future. All right, so crude oil, as I've been talking about, is in a pretty decent downtrend here. We rebounded and bounced off of the 200, but everything's looking south here. Doesn't seem to be anything that looks good at all. And I saw some numbers, I think out of OPEC or somewhere, that they're talking about that oil demand is going to be down next year. We'll see. It's very possible that's the case, but this chart is definitely showing a downside here, which probably, if Powell told us the truth, he said that they want to see movement in the core inflation numbers, and so they maybe they don't care about what's going on here. The headline numbers might continue to get better, and that'll certainly generate a lot of narrative around the markets and people talking about all kinds of stuff and deflation and who knows what all. And just know that probably my little chat about, no pun intended, a chat GPT, is that is probably deflationary as well from the standpoint of productivity and bringing in more productivity there as well. So just look for crude. This is a weekly chart. We're going to stay with this. We'll probably do weekly we'll start with weekly on the gold as well. So let's go ahead and do that. We should be able to get down pretty quick here today. All right, so gold basically came down just a touch below that 21. I've been telling you, look for basically a sandwich between the 21 and 10. The 10 is got a 0.27 decline on PPM1, so it's not really robust. There's still probably a 40% probability we could trade above the value of the 10, 1989, probably maybe even trade up as high as 2000. But the angle on the upside of PPM2 is only 0.10, and this is weekly. So like I've been saying, there's 3 Fibonacci numbers to watch for. And that first number, 1921, 1858, and 1819. So I still think there's some potential to get down to the 18 handle on this. And I think the patterns that we get over the next couple of weeks will tell us a little bit more. It does look like there is a little bit of a pop coming in the potential for the PPM2 here. We'll see how it plays out as we go forward. Let me just so you can see PPM2 is still fading as well, and then PPM3 is actually still going to be the major support. It's right at that fib target 2 right now. So just look for that to be the key point on the chart. don't see anything that's going to push this market much higher at the moment. All right, so final market, Bitcoin. We're seeing Bitcoin trying to make a bit of a turn here on a weekly basis. So we still have overhead resistance, PPM1's 0.97. We're trading below the 21. It's positive. So markets are going to want, this market's going to want to stay right around these values right here. And we're looking at 26,171, something of that sort is going to be the support. We get down to 24.7. And so we're trading a little bit below that. And it looks like we're going to see momentum continue to drift lower because PPM1 is a minus 0.97. So that's going to be your major resistance, 27.6. So that's where you want, if you're trading, you definitely want to trade out of things there. You're probably not going to get above that level. Okay, folks, I'll come back up on screen here. Thanks for watching. Another week's gone by. It's hard to believe. Crazy, crazy how fast time goes, but it does. I hope you folks had a good week because there was a lot of good movement on the upside. It was all one-sided, so hopefully I kept you guys pointed in the right direction. So anyway, make sure before you leave, hit the like button, subscribe, hit the notification bell, and we'll go from there. I was trying to look at some of the comments that were out there. Yeah, I see some FF was saying that after decades of tail wagging, the tail wagging the dog, we're now going to see the other way around. And that has been my argument for a while. And it goes, like I said, it goes back to what Powell said probably maybe 3 meetings ago, and I was the only one that heard it, but he said it. And they're going to keep these yields. And he kind of referenced something the other day. I thought I heard that he keeps telling everybody it's not longer, it's higher for longer. It's just normalization. At some stage, when we start to hear that in the we'll call it national narrative or in the financial news media, then we'll know they finally caught on what's going on. But most people are still thinking somehow the economy is going to get bad and the Fed's going to lower rates and all that stuff. And Paul did mention something about lowering rates when it was appropriate, but that would be, once again, when the markets are lowering the rates. I still think we go, not because I've been around for a long time, but I still think we go back to the Fed of old, which is adjusting the rates to the market, not pushing the market in the way that they want it to go. This manipulation game is over. And I think you'll find, especially a lot of you younger folks, you'll find that if we get back into that type of structure in the economy and structure from the cost structure of interest rates getting back to that level, you're going to find that it is going to be a much better, more stable economy as we go forward. And man, you folks are lucky because there's going to be some crazy cool stuff that comes out in the economy in the next 20 years. It's going to be pretty amazing. Anyway, folks, thanks a lot for watching. This is it for Friday. This video's for Friday. So I will see you on Sunday at 6 o'clock. Thanks a lot. See you later.
Bye.